Hello and welcome to Morning Trade with Moneycontrol. I'm Sumaira Abidi and I'm here to help you navigate the trading day with actionable trading strategies, sectoral trends and most importantly, your queries answered live during the course of the show. So keep commenting on our live feed and we'll have it addressed by our guests through this show. But before that, let's take a look at what the global handover looks like this morning. Wall Street has ended Thursday's trading session higher, with the Dow Jones gaining over 1%, the S&P 500 has risen about 2%, and the tech-heavy Nasdaq, the day's outperformer, surging nearly 3%. In fact, the Nasdaq led Wall Street higher as indices attempted to break a 7-week-long losing streak. Strong retail sector earnings have boosted sentiment, although benchmarks remain well off of their life highs. But it's a good morning in Asia. In the Asia-Pacific region, the markets have opened largely higher. The SGX Nifty is signaling another strong start for the Indian market, over 0.5% higher on that one for now. But let's welcome our first guest. Ajit Mishra of Religare Broking joins in to talk about all the stocks which can be in focus this morning. Hi Ajit, thanks very much for joining in. First let's talk about the market itself because, yesterday was expiry. We have a new series starting today. Do we expect more volatility ahead?
Yeah, good morning, Sumaira. So, yes, volatility is here to stay because we are taking clues from the global market, and though we are seeing some sort of respite in the global market, especially US, but it's too early to say that we have bottomed out and we are out of woods. So, volatility will continue in the domestic front as well. And talking about the indices, banking basically played a critical role in yesterday's trade to help the index to rebound. But if you talk about expiry to expiry, the last expiry we've lost nearly 6%. So now index, especially when we're talking about index, that means Nifty 15. 700, 600 and close to around 16,400 is basically what the current range is. So we need a decisive close above 16,400 for any further rebound or sustainable move in the Nifty. But meanwhile, stock specific, sector specific is something that one should focus on.
Yeah, absolutely. In fact, the March series has been the only positive series for the Indian market in this year, where we had gained about 1,200 points. Every other series for this year, we have only been on the downside. And in this particular one, of course, losing over 1,000 points. But Ajit, in terms of stocks, I want to talk about some stocks which are in the news. So let's take Hindalco, for instance. Earnings are looking good, net debt is lower, but that's the fundamental analysis. Technically, how do you think the stock is placed?
So, see, in fact, the entire metal space, we have seen a very sharp correction last, 1 month, and Hindalco was trading in sync with the trend. And, after, retracing from around 625 to around 400 levels, we have seen some sort of consolidation in the stock. So, yes, after the numbers, we may see some respite, rebound towards 430, 440 levels. But since the entire metal pack is slightly in the backward, I would recommend, in case if you're holding long, you should utilize this rebound to exit longs and avoid any fresh long in the metal space until we see a sign of decisive reversal in the entire metal pack.
Okay. In fact, on that note, what is your call on NMDC?
See, NMDC, in fact, after this breakout failure, because we were hoping close to around 145 levels, it had made a buying pivot, but it couldn't sustain. In fact, the last trading session itself, it fizzled out below the previous swing low. So now we are again closer to the monthly support area, which is around 120 levels. So it may consolidate a bit, but if we compare it with the other, metal majors, so I would recommend sticking with, JSW Steel, Jindal Steel, Tata Steel, and Hindalco for a time being, because SAIL and NMDC, these two counters look slightly on the back foot right now.
Okay, in fact, we had a query coming in from Sudipto Mondal as well, who wanted this view on NMDC. So, Sudipto, I hope you were listening in to Ajit's answer. The other, segment to talk about is paints. Right, because over here, fundamentally, the news is that, of course, we're seeing the, Birla Group wanting to make a very, very strong entry over here. Also, in terms of other news, Berger Paints announced numbers, and, in terms of volume growth, there's a bit of a disappointment because there's actually volume contraction. This is likely, they have hiked prices as well. So, Ajit, technically speaking, what is the upside for Berger, and, in this sector, what would be the best position stock?
Sumaira, after this news of Grasim increasing its capex plan, we have seen a very sharp reaction to the downside. The major paint players Asian Paints, Berger Paints, and Asian Paints. We usually don't see such candles on the weekly charts. It's down by around 9% so far, but the positive thing is that the immediate relief is around the corner because we have a support around 2750. So yes, we may see a respite and a move towards 2940, 2950 levels in the near future, but it's not a buying opportunity because the overall structure has deteriorated a bit. And similarly for the Berger Paint, we have seen a very sharp correction. So I would recommend, in case of your position, we may see a rebound, try to exit long positions and let these paint stocks stabilize first.
Okay, Navneet has sent in a query as well. He wants your view on the PSU banks and, if I can just expand it. Within it, technically, which are the best position stocks? Because some of them have had a very, very challenging month. So is any of these stocks now a good opportunity to start nibbling it?
Within the PSU basket, we only like SBI because if you see the overall performance, that largely remain in line with the private banking majors. And if you talk about the second ranks like Bank of Baroda, Can Bank, though we have seen a rebound, but gradually we are seeing those moves fizzling out. So I would recommend, in case if you wish to go ahead only with the PSUs, then SBI should be your choice.
Okay. In fact, let me increase the scope of the financials. Muthoot Finance, because they came out with numbers. Numbers are a bit disappointing, but brokerages still maintain a buy call, saying that for the underbanked segment, this Muthoot Finance is still a very good opportunity because they have to reach out to them for personal and business loans. So therefore, there is upside still for this stock. But Ajit, what exactly is this upside over say the next 1-2 years?
It's definitely a good, positional trade if we see, considering the long-term uptrend. But I would recommend not to go ahead with the entire position at one go. One can start nibbling at the current levels around 1130, 1135 zone, and add more in case if it slips towards 1080 levels for the long-term view. Upside in the next swing, it could retest the level close to around 1450 to 1600.
Okay, another well-tracked stock is Motherson Sumi. Now over here, they have found in this quarter that operationally it's very, very tough. Plus, of course, they have that whole Europe exposure, so that's another added worry for them. How does the stock look to you, and this whole, auto ancillary pack, what is your call on it?
In fact, Sumaira, we've seen a very strong surge in the auto pack, of late, but we saw that, select, ancillaries, counters participated in the move, and Motherson is slightly on the back foot right now. So I would recommend, in case if your view is long-term, definitely we have this level of close to around 100, 110, wherein we have monthly supports and one can start nibbling selectively. But from the trader perspective, we are still not seeing any sign of reversal yet. So in case if you want to go ahead for the short-term trade, you should wait for a breakout above 130. In that case, we may see move towards 145, 150 levels in the near future. But in case if you wish to go ahead in this particular segment, Jamuna Auto is very well placed. The stock is trading at the record highs. And then we have, Apollo Tires from the tire space, which one can look at.
Okay. What about Zee Entertainment?
See, Zee, though, post news of, merger, we saw the initial uptake, but the entire move fizzled out, gradually. And now we are again seeing this stock is hovering around the monthly supports of around 220, 230 levels. So the overall trend is still negative, Sumaira. So I wouldn't recommend, even for the short-term trading or for investment at the current levels, let the stock stabilize, let the stock form some base and some, sign of a reversal pattern. So far, the trend is still negative, and any breakdown below 220 can again push the stock toward 180, 160 levels.
Okay, now let's shift our focus to the pharma pack because we have Krish asking us on the live feed whether Glenmark is a good buying opportunity right now. So, on Glenmark itself and, amongst peers, what do you like?
See, Glenmark, if I'm not wrong, we have results scheduled in a day or two, and the stock is, witnessing a gradual decline. It's trading below all its, important moving averages, and the support is close to around 360, 355 zone. So I would recommend to avoid Glenmark. Within the pharma space, Cipla and Sun Pharma, they are better placed. We have seen Dr. Reddy also witnessing a very sharp rebound. So these three names that one can look at.
Okay. BPCL is another stock in focus today. The fundamental news is that the government has called off present EOI process for BPCL. So the divestment as of now looks like it's been called off. But Ajit, technically, this entire pack has been brutalized. So would you say, stay away or even short?
See, fresh shorting I won't recommend because we have a support around the 315 levels on the weekly and monthly chart. But yes, in case if it witnesses any rebound close to around 335, 340 zone, that could be the area basically where one can look for fresh shorting position if the market allows.
Okay, one final question coming in from Arun Srinivas. He wants to know, is it a good time to accumulate Relaxo for a 1-year holding period?
See, Relaxo definitely is one of the stocks which generated decent wealth for the investors, and we have seen a decent correction from the top as well, from roughly around 1440 to around 960 levels now. So yes, you can start accumulating the stock gradually, and your range should be in the range of 850 to 950. And with a 1-year time horizon, the first immediate hurdle it could be close to around 1140, 1150 area.
Okay, and Ajit, finally, what are the stocks on your list today?
Sumaira, considering the trend that we are seeing in, and plus we have this overnight risk also, I would recommend maintaining long and short approach when it comes to stocks. So, first on the list, we have Colgate Palmolive. The stock has, witnessed a decent consolidation of late, and we have seen a very sharp, rebound in the last trading session. So, we expect this move to extend further, and close to around 1700 is what we are eyeing as a immediate target for Colgate with a stop loss of around 1550. The second stock in our list was Max Financial Services. So after a very a sharp correction from the top, the stock has formed a decent base around the long-term moving average support area. So we expect a strong rebound from the current levels for the level of close to around 820. One can go long with the stop loss around 740. And lastly on the list, we have Havels to go short end. The stock has been hovering in a range, and in the last trading session, we have seen a fresh breakdown. So now we expect the stock to test around 1100 levels with stop of around 1220. One can go short.
All right, Ajit, thanks for your time. Have a good trading day. With that, let's also get in some fundamental take on the market now. Sujan Hajra, Executive Director of Institutional Equities and Chief Economist at the Anand Rathi Group, joins in. Hi, Mr. Hajra. Morning. Thanks very much for joining in. I want to start by talking about these IT stocks, right? Because they have been a big favorite. But now even the big names, and I don't mean the mid-cap or the small IT companies, the big boys, they're available at deep discounts. And, unless the expectation is that perhaps a recession is coming and these companies will therefore be negatively impacted, would you say that investors should use this opportunity to buy?
Yeah, good morning. Yes, if you look at, first of all, a recession, a technical recession cannot be ruled out. As you know, yesterday, the US has revised the March quarter data, and it's deeper into negative. Technically speaking, 2 quarters of negative growth is a technical recession. So we cannot rule out a technical recession either in US or in Europe. But having said that, obviously, we are not looking for a prolonged recession. So from that perspective, yes, our medium-term outlook on the equity market is positive. And from that perspective, IT definitely is one of our most preferred sectors. We have seen that the March quarter results for most IT companies are over. And at the aggregate level, we are seeing that the sales growth is in excess of 20%. The PAT growth is in excess of 40%, which are significantly higher than the long-term averages. And at the same time, if you look at in terms of the valuation multiples, while those are not cheap, but they are broadly in the average for the last 5-6 years. So from that perspective, we are positive. We know that there are quite a few headwinds for the sector. For example, the expenses growth is accelerating, or it has accelerated both in terms of the direct cost and indirect cost. But going forward, we remain positive on IT sector. So I would agree with you. IT looks from a strategy perspective, IT looks pretty attractive, and we are overweight on the sector.
Okay, but would you say that metals is another similar theme? Because here as well, we are seeing that marquee companies are available at superb prices, and at a time when their balance sheets are perhaps in the best positions that we have seen them in a long time. So would it be time to also lap up metals?
No, obviously, from a macro perspective, the metals and IT are very differently placed. Metals are super cyclicals, global cyclicals. And we have seen in the last 10 years, most period of the last 10 years, this sector has done pretty badly. In the last 2 years, metal sector has done pretty well. In fact, if you look at from the bottom of the last 5 years, the sector has rallied almost even now 260% from the bottom. So the sector has already seen very significant rally. Now, going forward, again, this sector can face some kind of headwind because our view is that the global growth is going to come down. And this being a macro sector with the slowdown of global growth, there can be some amount of negative implications. Having said that, if you look at the valuations, whether you look at in terms of PE, you look at in terms of EBITDA or any other multiple, the metal stocks still look pretty attractive. And we think that will, despite the slowdown of global growth, some level of attractiveness will continue. In terms of segment, we prefer non-ferrous over ferrous. So we are not very comfortable with the ferrous pack, but non-ferrous side, we are positive.
Okay. The other sector to focus on is, of course, the financials, right? Because now we are seeing that the traditional banks, they are seeing better offtake. The expectation is that asset quality is likely to improve from here. And on the other side, the fintechs who were thought to be the big disruptors are not seeing the kind of growth which was earlier envisaged. So, should banks now start focusing once again big time on the buying list?
Yeah, in the last 2 years, we have seen that the banks, usually which is the favorite of the market, has underperformed. Though there has been some catch up in the last 6 months or so, but once again, banks are underperforming. I totally agree with you. If you look at in terms of credit growth, in terms of deposit growth, in terms of loan delinquency, so therefore provisioning requirement, or even the capitalization levels, banks are comfortably placed. And while we are going to see, we are already in the midst of a rate hike cycle. Generally, during the rate hike cycle, if anything, the net interest margin of the banks improve. So from that perspective, also fundamentally, banks look attractive. In valuation terms, like IT companies, they are not cheap, but they are not very expensive either. So that comfort is also there. One little thing is that the ownership of the banks, if you look at, if you go from the broad market, Nifty 500, the sort of index weight for banks are about 28%, whereas both FIs and mutual funds hold banks to the extent of 32%. So despite the negative sentiments about banks in the last 24 months, or the financial sector as such, they are not underweight. We think going forward, banks will outperform the broad market, though we don't feel that the extent of outperformance will be particularly marked. So far as the fintechs are concerned, I think we overestimated the impact of fintech on traditional banks. And that hasn't played out to a large extent. And if you look at the fintechs have their own problems, which is quite irrespective of their competitiveness towards banks. This does not necessarily mean fintechs eventually won't be a bigger competition for the banks. But as of now, we don't see the fintechs to be a big competition to banks. On the top of that, if you look at the kind of technology which fintechs use, banks are actually internally adopting to that. So to that extent, banks will be able to counter a bit of competition from the fintechs even in the future.
Okay. Finally, on these new age tech companies, new listings like even say Paytm are available at what quarter of their IPO price, even lower than the valuation at which they had raised funds, say 2-3 years ago. So would you say that, this big discounts that we are seeing now, is it a buying opportunity or is it like trying to catch a falling knife?
Valuing the new tech companies traditionally has been a big challenge for the equity market. And we have seen it in the dot-com bust as well. And to be very frank, as we have seen during the dot-com bubble, some of the problem for these companies, new age companies, could be existentialist. So you don't know, many of them might not actually survive in the longer term. So say it's like this the technology part which they are bringing, the other things which they are bringing are extremely robust, and those are extremely useful, but that cannot be necessarily said about the individual companies. So until and unless you have very deep understanding and insider knowledge of some of these companies, you have a huge amount of risk tolerance, and you have a long investment horizon. At least in this volatile phase of the market, I think it's better to avoid this kind of companies. But as I said, some of these companies can emerge as multi-baggers from these levels, but we just don't know which one of these companies will do that.
Okay. Mr. Hajra, just one final question. We've spoken a lot of stocks and sectors, but overall in the market, what is the take? Do you expect more volatility ahead? And how long could this, pain last?
See, obviously, if you look at right now we are moving from a period of inflation scare and aggressive monetary tightening by central banks, perhaps to a phase where we will be far more scared about growth. And word which scares the equity market the most is stagflation. And perhaps we are heading towards a situation where the inflation will still remain elevated, but the growth will come down significantly. So therefore, I think we are going into a phase which could be slightly more scary than what we are already in. Is it already in price? I think to a large extent, this is already in price. But it's extremely difficult under any circumstance to tell you to time the market perfectly. So therefore, while I see definitely next 3 to 6 months, the market is likely to remain volatile. There is possibility of further correction of the market from this level. But having said that, in the longer term, equity market is driven only by 3 factors: the fundamentals, both macro and corporate, liquidity flow towards the equity market, and valuations. And I think on all these 3 parameters, Indian equity is favorably placed from a medium to longer term perspective. So despite our slightly negative view in the near term, we remain pretty positive about the medium to longer term prospect of the market.
All right, Mr. Hajra, thanks very much for joining in. Have a good day and a good weekend. With that, we're going to wind up on this edition of Morning Trade. Do stay tuned in. Markets with Santa and CJ comes up next.